Welcome to our class on estate planning. Yes, when you pass away, you still have to pay taxes and worry about your finances. So with this course, we're going to go over some fundamental concepts of estate planning, or planning in the event that you become incapable of making decisions for yourself. Just a couple of concepts that you need to be aware of when you're planning for that in the future. Here are some basic definitions. An estate are your assets minus your debts once you pass away. So after all your debts are paid off, whatever is left over is considered your estate. Estate planning is the process of figuring out how you're going to allocate your wealth once you pass away. A will is a legal document or a legal request for how your estate will be distributed upon your death, or designate a guardian for your children if necessary in the event that you die before they come of age to take care of themselves. Beneficiaries are those that are receiving your assets from your estate. The executor, or your personal representative, is the person assigned to execute instructions for the distribution of the will. Your letter of last instruction is a letter regarding funeral arrangements and identifies the location of any key documents that you have, like the title of your house or the title of your car, the deed to your house. That type of paperwork would be in your letter of last instruction, Freudian slip, to figure out where everything is once you pass away. Your codicea is a document specifying a change in will. So at any point in time you want to change one of your beneficiaries or add a beneficiary, you would need this document to specify that change. And the last definition on this page is a probate, which is the legal process of declaring a will valid and ensuring the orderly distribution of the assets. Common types of estates are a simple will. This is typically for smaller estates distributed to one person. And then you have a traditional marital share will, which is typically for larger estates, where estates are split between the spouse and their children. Again, you pay taxes when you die. The first 3.5 million of an estate is not taxed. The remaining taxable rate on your estate after that 3.5 million is about 45%, or up to 45%. 3.5 million may seem like a lot, but if you take into account the insurance policies that you have taken out, the value of your house, your savings from retirement, any other asset added up, $3.5 million actually accumulates quite quickly when you add all those things together. Some states actually impose inheritance taxes. To get the exact numbers for your state, go to your state website or your state government website to find out what the inheritance taxes are in your particular state. The important thing to figure out is when your net worth exceeds the tax-free limit, you should strategically plan to minimize the number of tax liabilities. And there's a few ways in which you can do that, from charitable contributions to gifts to family members to trust funds and things of that nature. And we're going to go over that in the next couple of slides. Trust and gifts. Trust is a legal document in which the owner of assets transfers these assets to a trustee to manage them for a beneficiary. A living trust is a trust in which you assign the management of your assets to a trustee while you're still alive. Pretty self-explanatory, a living trust. There are also revocable and irrevocable trust, which gives you the option to maintain ownership of your assets in a revocable trust, and you legally transferred your ownership to the trustee in an irrevocable trust. In a revocable trust, that means at any point in time you can say, hey, look, I'm going to dissolve this trust account and I'm going to take back all of my assets and take care of them on my own. Whereas in an irrevocable trust, you no longer legally own your assets, but you're still earning an income off of these assets. The good thing about an irrevocable asset is you're not hit with the estate taxes once you pass away. That income's still distributed to your beneficiaries without being taxed. There's also a standard family trust, which is a trust started for children in the family. A testamentary trust, which is a trust that's created by a will. Gifts, you can have tax-free gifts of up to $11,000 per year per person to another individual. So if you're starting early with giving your kids gifts of up to $11,000, you can greatly reduce your tax liability. Let's say, for instance, there's 2 parents with 3 kids. Each year you can give tax-free of up to $66,000. You do that over the course of 10 years, $660,000 has been removed from your estate. You do that 20 years, over $1 million. You do that over 30 years, 40 years, over 2-3 million, which adds up very quickly so that you can take away from that tax liability. And all money left for charitable contributions are not taxed. You can also do estate planning while you're alive. There's a living will, which is a legal document specifying preference in the event that you become ill. So let's say, for instance, you get some mental illness and you can no longer take care of yourself. A living will gives preferences of what you want done to your estate or who you want taking care of you in that event. Power of attorney is a legal document granting a person the power to make decisions for you in the event that you become incapable. And a durable power of attorney for healthcare is a legal document granting a person the right to make healthcare decisions for you. Let's say, for instance, you're on life support. That person could make the decision of whether or not to pull the plug or to hold on or whatever the case may be. This concludes our class on estate planning. This is also the end of new concepts that you're going to be learning for Introduction to Financial Planning. You all did a great job listening through. If you guys are actually signed on to Debtless Community, you've also been taking quizzes and keeping yourself refreshed on these courses every time you move on. The very last class that we're going to go over, there's going to be no new material that's going to be presented. It's just going to show you how to integrate all of these financial planning tools and concepts into one to create a working financial plan. With that being said, thank you very much for listening to the course, not only for me, but for yourself to improve your personal financial literacy. You've done a wonderful job. Take care. See you in the last video.